What's up, guys? My name is Darren Jackson. Welcome back to the channel. And last week was pretty insane, to say the least. I've been pretty used to seeing stocks being very volatile and stuff, but the amount of volatility that certain stocks had over the course of a period of time, a small period of time, and more importantly, the reason why is why I feel like last week was probably one of the most important weeks for the stock market as a whole and for all parties involved. And whenever you learn something important or you discover something important, there's obviously lessons that you learn from it. So from this entire previous week, there are definitely 3 lessons that I want to make sure that all new investors, including myself, take away from this. But I'm going to discuss that at the end of this video, so make sure you stay tuned. But right now, we're going to get down to the main point, and hopefully I can help you answer the question, what in the hell happened last week? So it took me a while to accumulate all the information and all the other companies and stocks that were involved in last week's big situation between 2 different groups of investors. But I think I got a good understanding of it. Make sure you get a pen and paper because I'm going to describe a lot of different terms that you may have not understood or completely understood before. So hopefully I can help out with that. And it took me a while to figure out where to start. But I feel like the best place to start is to go maybe 15 years ago, to where this one company was a juggernaut on hardware video games and consoles, and that company was GameStop. GameStop was a company where you could go in, try out the new video games, buy the actual disc, or buy the console that just came out. I do remember having a lot of conversations with my friends in junior high and high school and hearing them talk about how long they waited in these lines to get the new Call of Duty. And I also remember waiting in the short lines to sell my PS2 games, all 40 of them for about $3. It's a tragedy. But regardless, GameStop was that one-stop shop, and I'm sure if we could pull up the information from their stocks, if they were public at that point, they were doing amazing. But over time, things changed. And when I say things changed, what I mean is that buying the actual hard copy of video games and even movies and stuff like that was less popular, and that became less popular when consoles like the PS4 and the Xbox One, and maybe even one series back with the PS3, gave you the opportunity to purchase video games digitally. All you had to do was download it, and it had the benefit of not having to get up and go to stores such as GameStop. And with that, GameStop eventually started to fall. Couldn't necessarily keep up with the times, and most people felt like it was a dying breed, with the exception of a couple of people. So there's one particular person who is a Reddit user on this huge Reddit sub-platform called WallStreetBets, which we'll get into that in just a second. But basically, he was one of probably a few people that actually believed that GameStop was way undervalued. He felt like GameStop could still succeed in the world at some point for some reason. So with that, he invested tens of thousands of dollars. I think they reported that he invested off the gate around $50,000, which was insane. Even Michael Burry invested into it. He believed that even though GameStop was primarily selling the hard copies of disc, that they could still survive because new consoles like the PS5 and the new Xbox are still offering hard copy games, and GameStop is the one place where you could get it from. And maybe they can even go digital and have an online market to where they can catch up and still make profits off that. And if you don't remember who Michael Burry is, he's this guy who was played by this guy in this movie. And if you haven't seen it, make sure you check it out. It's actually pretty cool. So back at that time in 2019, those were 2 of probably the few people that actually put money towards GameStop, believing that GameStop would survive. And they weren't completely wrong. So the next year, GameStop actually focused more on digital sales, and their sales went up to over 519% by June, I believe. And that was after having to drop a lot of the buildings that they had because they were losing a lot of money in general. And after that, a lot of other investors came into play, including former CEO of Chewy, who put enough money into the company to own 9% of it, and even believed that they can make this company into the Amazon of video games. And then shortly after that, their percentages of digital sales went up even higher, and he invested into even more. So for that point, that Reddit user looked like he was onto something and was starting to make some profits from that. So unfortunately, the situation with GameStop didn't go towards a happy ending. If you check GameStop's stock price, I'm pretty sure it revolved around $2 to $4 a share around that time. And not only were people, including the subreddit users of WallStreetBets, able to notice that, but they were also able to figure out why exactly that was happening. And this is where I want to introduce a term to you guys called shorting the market. So this company had been shorted. It was shorted so much that there were more stocks within GameStop that were being shorted as opposed to how many outstanding shares or how many stocks they actually had available in the market. Now, that doesn't seem as crazy, especially for you guys that don't know what shorting is. So obviously I'll explain it to you. Now, the best way I can explain what shorting a stock is by going back to the very general reason why people invest in the first place. Ideally, you put $10 into a company like Apple because you use their products and you really believe in what they're doing and you think they're gonna do a lot better. Then they do a lot better and their profits go up. And because their profits go up, the money you put in increases and your $10 turns into 15 or 20. You take that back out and congratulations, you made a profit. You made that profit off a company you believed in. Inversely, you can make profit off a company you don't believe in or you feel like regardless isn't going to do well because of whatever reason. So when you short a company, what you're basically doing is betting against it. And the way that works, hopefully without confusing you guys so much, is that you borrow money from your broker. So for example, if you're investing through Robinhood, you'll borrow money, or in this case, a certain amount of shares through Robinhood. So let's say this company is company X, and they're currently worth $10 a share, and you feel like they're going to do really bad. So you borrow 100 shares worth of company X from your broker, which at that point equates to $1,000. As soon as you get that $1,000 worth of 100 shares of company X, you immediately sell it into the market. So now you currently have a $1,000 balance, but you owe that to Robinhood because $1,000 at that very moment is the equivalent of 100 shares of company X. But remember, you don't believe that they're going to go up. You believe they're going to go down. So let's say you wait, and about a month later, they continue to do bad, and the share price of company X goes from $10 to $5. So with that $1,000, you buy back in 100 shares of company X because you only owe Robinhood 100 shares of company X, no matter how much it is. But this time, 100 shares of company X is only worth $500. And all Robinhood cares about is, where's my 100 shares at? So once you get that back, you give them the 100 shares, but you profit $500 because the price went from being $1,000 for 100 shares to $500 for 100 shares because the stock price went down. So you get to pocket the rest. So ultimately the goal is to be able to profit off a company's demise, which is pretty sad. But for the people that were doing that for GameStop, you can't really blame them. They did the research, they understood where GameStop was at, they understood where the world is at now and what role GameStop plays or lack thereof, and they predicted that the company wouldn't do well. They could be right, and if they're wrong, then you lose money. So the problem with me wasn't just the fact that people were shorting GameStop stocks. It sounds fair. The problem with me is the magnitude of how much they were being shorted. More importantly, who was doing the shorting of GameStop stocks. And that is a company called Melvin Capital. So Melvin Capital is a hedge fund. Imagine a hedge fund being a pool of money from a bunch of rich people, because honestly, you have to be pretty rich to be able to invest into a hedge fund. And the managers of those hedge funds take that entire pool of money, and their end game is to help those investors make more money. So they'll take your money and they'll buy stocks, sell stocks, day trade, and they'll do additional things such as swing trading and, you guessed it, options trading and shorting stocks. Whatever they can do to help you make money. And this company was pretty much doing that. But when you have a pool of a numerous amounts of pretty wealthy people, that's a lot of money they can put towards a company to short it, expecting its demise, and ultimately manipulating the stock market. And hopefully at this point you understand how big of a deal that it is that there are more shorted GameStop stocks than there are actual stocks of GameStop. It doesn't really make sense. But with that is another lesson that you need to keep in mind. So as I said before, when you short a stock expecting it to go down, you can gain profit from that. The only way you won't gain profit and in fact lose profit is if the company does really well and the stock price goes up. And unfortunately, the amount it could go up is endless. So essentially your losses at that point are infinite. And back to Wall Street Bets, those investors knew that. So what they decided to do was band together and create essentially their own hedge fund of retail investors and not only buy shares of stock in GameStop, but actually do call options. they bought call options, which is another definition I'm going to explain to you. So when you buy a call option, it's basically the opposite of what these hedge funds do. You are essentially buying a contract, assuming that the price of this company's stock is going to increase. You're betting that the company's going to do really well, which is similar to just buying a share of stock, except you can make even more money. And the way that works is, let's say that I believe that company X, which is currently worth $10 a share, instead of going down to $5 a share, it's going to go up to $20 a share within a 2 to 3 month period. So there's that. So I am purchasing the right to be able to buy that stock at $20 a share. And instead of me having to pay $10 a share for 100 shares or $1,000 out the gate, I pay a premium, which fluctuates based off the company you're buying, the price that it is, and how long the contract is, or how long you're giving yourself until it reaches that price. And that just may be hundreds of dollars. And if it reaches that price, then you're able to buy that stock at that price, which would be, in this case, $20 a share with 100 shares, or $2,000. Then you sell it, you minus the premium that you paid, and boom, there's your profit. Good news is, if it keeps going, the price keeps going higher, then you gain more profit. So that's what these investors did. But it wasn't all about making money. And this is where things get really cool. So as I said before, the only other way to lose money when you short a stock is for the price to go up instead of going down. And the only way to stop the bleeding of how much you're losing is to end the contract. The only way you end the contract is by buying back into that company. But this time, instead of buying it back at $10 a share or less, that company may currently be worth $20. So you're spending more than what you essentially made, which results in that loss. So when these retail investors on WallStreetBets and everyone else that jumped in decided to buy shares of stock of GameStop and buying call options of GameStop, those moves alone increased the price of GameStop stock, which is the complete opposite of what these hedge funds wanted to happen. And over time, as they waited, the price of the stock went higher and higher and higher. And what's even crazier is, considering the fact that there were more stocks shorted for GameStop than they are existing, when they bought back into the stock market to stop the bleeding, they were forced to buy back from the people that were holding options on those stocks. And when you hold an option, you're holding it for a duration of time. 2 to 3 months. So that's 2 to 3 months worth of an increase that GameStop would have. That primarily explains why GameStop went from $20 or something like that per share to almost $300, or not almost, over $300 at one point. And people that work for these hedge funds, or investors of these hedge funds, had no other choice but to sell out, because the more they waited, the more money they lost. So essentially, they were pretty much sticking it to the man, I guess. Now, as I heard about all this information and people describing the situation as a war between retail investors and hedge funds, I couldn't really understand why this was a war. It just seemed like retail investors were taking the opportunity to make a lot of money because hedge funds were shorting the market. And if they could buy in, it forces hedge funds to buy in, so they stop making money, which forces the share of GameStop to shoot up, which makes them make more money. But maybe there was a bigger situation at hand. Maybe this was a little bit about morals as opposed to just making money. Making money is great. And I found out something else about hedge funds. And this surrounds another term I'm going to teach you guys. That's called leverage buyout. Let's say there's a hedge fund and it wants to use all the money that investors have poured into it to buy a company that may not be doing well. They're buying a company regardless. So at this point, they put all that money towards a company, and now they still owe their investors certain money, at least the money they put in, so they even out. So this hedge fund is currently in debt. However, let's say that all that money they put into the company gives them majority ownership of that company. So they basically own this new company now, and with that, they can take the debt that they owe to the investors and put that debt instead on the company. And unfortunately, it doesn't show up on the hedge fund's balance sheets. It doesn't show as a liability on the hedge fund. I guess as far as a level of hierarchy, it shows for the actual company themselves. So now it becomes the company's debt. And there's only one way a company can pay off that debt, aside from going bankrupt. They have to start selling their assets, closing down their buildings, saving money, firing employees, doing whatever they have to do to pay that off. And the hedge fund at that point is doing okay. At this point, they don't have any debt and they just made even more money. So the whole idea was that these large hedge funds have so much power, maybe even too much power, and these investors knew that. Yes, they knew they could make a lot of money off this situation if everyone band together, but they knew they wanted to stop this whole weird manipulation of the stock market. And at this point now, just like yourself and a lot of you, I'm waiting to see what the stock market's going to do next, if these investors are going to keep punching money into GameStop and other companies such as Dillard's and AMC, and what these other big corporations are going to do. But with all that being said, here are the 3 lessons that I feel like all investors, especially if you're new, need to take away from the situation. The first lesson seems pretty clear-cut, but definitely needs to be reminded, is to understand how the stock market works. People definitely need to keep in mind on why stock prices go up and why stock prices go down. Because it's not always because people believe in the company, so they put money towards it and it goes up, or they're starting to question the company and they take money out and the stock price goes down. It could be manipulated to a certain degree, so you definitely have to keep that in mind. The second lesson is another obvious one, and that's invest what you can afford to lose. You have to assume that every time you invest money into the stock market, you could potentially lose all of it. Hopefully you gain more, and if you're doing your research and you're investing to the right companies and doing the right strategies, you will. But it's very possible you'll lose it. So don't put your hard-earned savings or your whole paycheck into the stock market and make it even riskier than it is, because it's already a risky situation and you lose all of it, and there you go. Now the third lesson I feel like might be the most important, and that is to pay attention to cryptocurrency. I say pay attention to cryptocurrency for a pretty specific reason. So when all this went down, a lot of brokerage apps responded the same exact way. And that was by halting trades of specific companies or even limiting them. And that is where a lot of the speculations come in and the theories come in of why specific companies, primarily and especially Robinhood, did it. But the point is, the stock market is a centralized situation. It is controlled by some external figure, the SEC amongst other things. So if they don't like what's going on, they have the power to stop it, whether it's good or bad. Inversely, cryptocurrency, it is decentralized. You have the blockchain, and that's pretty much it. It records all the trading, and there's really no other control. People are free to trade as they choose, and it's up to the investor to understand, yet again, how the stock market works, or similarly, why cryptocurrency goes up and goes down. It's not ironic that while brokers were shutting down trades of certain stocks and those stock prices were going down, that at the same time, Dogecoin and other altcoins were going up. There's a situation at hand that I think we all need to pay attention to and definitely keep in mind on cryptocurrency. But this whole situation is pretty crazy, and I'm really excited to see what happens next and how everybody essentially responds, and how ultimately the stock market could potentially change forever just because a group of Reddit users decide to stick it to the man and make a lot of money. So let me know what you guys think down below. How do you feel about this whole situation? Have you switched brokers, and if so, which ones have you switched to? Just how you feel overall. Make sure you leave your comments below. I appreciate you guys watching. Make sure you watch some of these other videos as well. Hopefully they help you on your investing journey as they have in mine. But until next time, take care.